Hi, everyone. This is Rohit from Rise to Mastery, and I'm excited to have Mark Phillips, who's the managing partner at 11 Tribes Ventures. Mark was a management consultant focusing on M&A between corporations and growth stage startups. Mark earned his MBA from University of Chicago Booth School of Business, focusing on entrepreneurial finance and strategic management. Welcome to the show, Mark.
Rohit, it's great to be here. Thank you for having me.
Awesome. So, before you started 11 Tribe Ventures, you were a consultant. You worked in a couple of VC funds. How did you get your entry into the world of venture capital?
Yeah, the story's a little bit longer than that. I did have some background working in the consultancy space for venture and did some work in venture capital. It was actually my first foray into entrepreneurship was actually as a founder. So during business school at the University of Chicago, I was able to launch a company, which was a healthcare hardware device for type 1 diabetics. It was called Ascent. I had built it. I was trying to scale it, and all to make a very, very long story short, Rohit, it didn't go well. We were building a product that ultimately a pretty significant competitor in the space released on their own, and we were kind of left there holding our designs about a year and a half behind, realizing that this business wasn't going to be successful. It was through that experience, Rohit, that I really struggled with personally, and just to be very candid, I struggled with this idea of how do we as entrepreneurs attach our identity and our value as people to the performance of our company, right? And we see this, I think, every day in entrepreneurship where people want to say, hey, I'm successful because my business is successful, but that's not true, right? I mean, we as people have our inherent value. And I, as an entrepreneur, really struggled with that when my business failed. So as I came through the failure of that business and kind of came out the other side, I became very convicted that I wanted to switch sides of the table. So spent time at Booth, really starting to understand entrepreneurial finance, operations, cap table management, all these good things that venture capitalists need to be aware of. And, after working in some venture funds in Chicagoland, I just became very, very passionate about the topic and explored what it would look like to launch my own fund. And so that was around 2017, 2018, over the course of a couple of years. To be very clear, launching a fund is not a quick endeavor. It is a time-consuming, lengthy endeavor. But after a couple of years, several years at least, of kind of exploring the idea, I launched our fund in 2021. And we've now been operating for just about 18 months.
So, super interesting. And you started at a B school. You've had a couple of stints at a VC firm. Are there any basic building blocks that can be taught in investing, or do you think a VC needs to learn from experience and time?
Oh boy, excellent question. And it's actually one of the things I struggle with as the managing partner of our firm. I think investing in general is a remarkably learned experience. And so you need to be around other people who have done it. If it was a science, we'd all have figured it out by now, right? Take this one, do that one, everybody makes a lot of money. It's not, it's an art, and so your answer, it's both and, of course, right? So it is an art, and I have tried to surround myself with individuals who aren't necessarily part of my firm, but play roles, advisors, and on boards for me personally, just to learn from that, because I recognize the necessity of that. But I also think there is a science component, right? There are some basic blocking and tackling aspects of venture capital and early stage finance, entrepreneurial finance, that anyone that's interested in breaking into venture capital needs to be aware of. You need to understand income statements, you need to understand balance sheets, you need to understand statement of cash flows, right? And so those are sort of the three integral pieces of any business, but that only gets you so far, right? That only gets you to understand it kind of sets the table, but then you got to prepare the meal, right? So what is it about this addressable market that we think is interesting? From our firm's perspective, we're also incredibly oriented around people. You have the horse and jockey analogy. Everybody has a different version of it or a different answer. We're very, very bullish on a jockey, right? We think that the right jockey can take a good idea, even in a bad market, or a bad idea in a good market, and make something successful of it. So I also think, if you've got the sort of apprenticeship, the art, if you will, I think that's critical. You have the science, you have to understand the finance of things. But then there's the third, unknown piece, I'm not sure how to categorize it, which is the emotional intelligence, right? How do you connect with people and understand what motivates them? Because I think an entrepreneur launching a startup with the wrong motivation is really a recipe for disaster. And so you have to really be able to master those three components. And I am at the very starting line of this whole process. I'm trying to master just as much as the next person, but I think that's a process a lot of folks should look into as they consider what it would look like to work in venture capital.
Interesting. And I want to understand how do you approach portfolio construction today, since you've been in the market for around 18 months?
Yeah, there's a lot to that question. It's been a wild 6 months, Rohit. I don't have to tell you or your listeners. It's been really, really tumultuous. We've seen a lot of, I think, appropriate correction of valuations throughout the market. We are really a seed stage investing firm. And so even since we launched in April of 2021, we've tried to remain extremely disciplined in terms of the valuations we're entering in at. And sort of what are the metrics we're looking to get a business at from a valuations perspective. Kind of getting to the core of your question, what are we looking at from a portfolio construction? We think about it in really three terms. The first is we want really, really healthy diversification for our limited investors, our LPs. So we are not an industry specific fund. We invest across healthcare, financial services, healthcare, financial services, agriculture, education. We do some Web3 investing as well. So we are really trying to focus on a diversification of industries to make sure that the investments we're making aren't going to have any correlations with each other. But in terms of portfolio construction beyond that, we do really look at the valuations, and we want to understand what's the entry multiple we're getting in at. And then every investment we make, we are expecting a 10x return on that investment. And so we have to be very, very specific about, okay, if we're getting in at a $10 million valuation, do we see a very specific path forward for that company to reach a $100 million valuation or more, right? So this is, and to any entrepreneur listening, this is how venture capitalists are thinking about their portfolio. That net, they want to end up at a 3, maybe 4x multiple on their invested capital. And so any investment they make has to reach that 10x because they know some of them are going to go to zero. Others are going to be sort of big winners. So that's really what we think about from a financial perspective. And then in terms of the third element I wanted to speak to was geographic. So in our investment portfolio, we are very specific about the geographies that we invest in, looking to really, I think, piggyback on something that happened in 2020, which was, I think, a decentralization of venture talent, right? In 2010 to 2020, safe to say north of 80% of all venture talent, venture founders were based in Silicon Valley, New York City, right? Oh. I don't know what the number is today. I think we'll find out at the next census, if you will. But I'm really confident based on what we've seen that a lot of those folks realized I don't have to build a business in Silicon Valley anymore. I can go to Nashville, Tennessee. I can go to Chattanooga, Atlanta, Cincinnati, Chicago. You pick your traditionally underfinanced geography, there's an incredible amount of talent there. And what I think not so many people realize is if I'm investing in a deal with a world-class founder in Nashville, Tennessee, I can get into that deal at a $10 million valuation as opposed to what would have been a $30 million valuation based in Silicon Valley. So that to me is just immediately a competitive advantage, and one that we are definitely trying to take advantage of within our own portfolio.
Interesting. And in your portfolio, do you look at what is the right level of diversification across the different sectors that you've invested in?
Sorry, can you ask that question one more time?
Like you said that you are not industry agnostic, but do you look at right level of diversification across the different sectors?
Yeah. So, the question we ask ourselves, I talk about the jockey. Obviously, you want to find a jockey that's in an industry that's expanding. Yeah. So in terms of how we're diversifying across them, our portfolio right now in Fund 1 is just about 30 companies. I think in total, the portfolio will be something in the range of 30 to 35. And so what we really look to do is cluster investments in each of these different industries. We don't have a specific allocation of capital. It's not to say, hey, listen, we've got $1 million health tech fund, we've got $1 million financial services fund. We have to be opportunistic in the deals that are coming to us. But we definitely are going to say to ourselves, hey, listen, at this point, we've got, let's say, 6 companies that are healthcare focused. We're probably not going to make any new healthcare investments based out of Fund 1. We're already starting to talk about what does Fund 2 look like and sort of, preheating those conversations, warehousing some opportunities as we raise Fund 2. But yeah, we are definitely focused on clustering those investments, but making sure we have clusters across a number of growing and expanding industries.
Got it. And do you also look at your ownership in your best companies? Do you think you can have a 20% of ownership in each of these your best companies over the years?
Yeah, ownership target, target equity percentage is a really important question. I'm glad that you asked it. We are a smaller fund, right? So listen, Fund 1 for us was $11 million. That gives us a little bit of capital to work with. When you get into some of these later deals, it becomes a little bit more challenging. We have a very specific follow-on strategy as well. We'll invest about 45 to 50% of initial capital into initial investments, right? So that's the first investment we make into a portfolio company. And then 55 to 60% of that capital will be reserved for follow-on. So no, to answer your question in short, no, we're not hitting a 20% ownership stake. We don't have the size to do that, obviously. We're targeting something between 5 and 7% in any deal that we're doing. And obviously that comes with the rights to maintain our pro rata equity ownership in any future rounds. And, you know, there's a lot of data and research to tell us that doubling down on the winners in the venture capital industry is really how you achieve that power law, right? So you want to see those power law returns, you've got to continue to grow with the winners. So depending on the size of the round, we've done a couple of follow-ons into the Series A. Depending on the size of the round, we may have the capital to increase that ownership in companies that seem to be accelerating very quickly. But on average, we're seeing ownership around 5% throughout our portfolio.
Interesting. And how do you approach outcome scenario planning, especially with your first fund?
It is. I think it's a tough question, if I'm being honest, for any venture capital firm that's at our stage to answer. It's not to say that it's not something that we take into consideration. As you look at outcomes, as you look at the potential for these firms to have successful exits, what we do know is that 80 to 85% of any successful exit is going to be through a strategic acquisition. Okay. Right. So what does that look like? That's the Microsofts, the Googles, the Amazons of the world coming around and gobbling up what could be potential competition. The number of initial public offerings that you're going to see in a portfolio of our construction is very, very small. And so what's the best way that you can start to support a portfolio company that, in all likelihood, if they are successful, they're going to have a strategic acquirer, is by making introductions. So when we go into a diligence phase of a portfolio company, are we saying, okay, we have to have a clear-cut plan for how this company is going to exit, what it's going to look like, who that acquirer is going to be? No, we don't. I don't think that's realistic. I think there's so many aspects of a startup at the seed stage that are going to change that is a bit of a fool's errand. What it does mean we can do is, on behalf of our portfolio, be making introductions to corporations and large enterprises that we think might be interested in the product. I think the single best thing that a startup can do to that end is bring in a Google, bring in a Microsoft, bring in a Workday as both a partner, i.e. an investor. All of these firms have venture arms, as well as a customer, right? Allow Workday to be using your product. And if they start to see what they like, they're going to start to think to themselves, well, it wouldn't cost us very much to buy this company up. And, on average, Workday is going to spend something north of $300 million to acquire a company. So outcome scenario planning is a piece of the puzzle. I don't think it's something that you can have written in stone. I think there's just so much variability to it. But, I think by continuing to make introductions on behalf of our portfolio to large enterprises and corporations, we can help move that ball along.
Correct. Also, you have a new fund, but you also look at, the loss rates and the downside protection about the startups which have failed.
Yeah. So let me make sure I understand the question. Sort of how are we constructing and how are we managing the portfolio from a perspective of how many companies are going to fail? Is that kind of what you're getting to?
Yeah.
It's interesting to me when we look at the venture capital industry and we look at the failure rates. Right. It's a little bit sobering, right? I mean, you picked the number, it's somewhere between 80 and 90% of all companies at any point when they're started are going to fail. And that number actually doesn't get that much better, Rohit, when you look at the companies that have taken on venture funding. And that's pretty disconcerting, right? I mean, our job as investors is to help mitigate the risks. And I would actually take it a little bit further. Our job as investors is to increase the odds of success. Right. And so if you ask yourself that question, what can an investor do? There's a number of things. One of the things we as a fund are doing is focusing on what I would describe as the mental health and the overall well-being of our portfolio founders. Very specifically, our average check size at the seed stage is $250,000. We allocate 2% on top of that. So in this scenario, $5K, but not within the check. So ultimately, our allocation to that company is going to be $255,000. $5,000 on top of that for the entrepreneur to put towards their own mental, their own emotional, their own spiritual well-being. The reason we did this is because as we launched this fund and we looked at the data, what it told us was that 60% of the time, the failure of startups is related to things like co-founder conflict, bad investor relationships, depression, anxiety, burnout. That's the stuff that in my estimation is really killing businesses. Yeah, the product matters, the go-to-market strategy, all these things, the team, vital. But if you have a team that is well constructed, you have a strong product, and you are well cared for,
right.
I believe that you're going to push through that adversity. And at the end of the day, I mean, if you really listen to the stories of the most successful entrepreneurs, what emerges to me is a story of grit. It is a story of resilience. And you're not going to be resilient if your marriage is falling apart, if you're not having conversations with your kids, if you are sacrificing, I'll use the term, if you're growing at all costs, and that costs involve things that are on your personal side, I really believe that your ability to have that resilience is incredibly decreased. So when we allocate this 2% to our founders, you know, it's a bit of a dual function. Obviously, I want them to work with coaches. I want them to work with leadership development, with counselors. We actually have a partner organization called Cadence Group. I'd encourage everybody listening to this to check them out, Cadence with a K. And they exist to provide these type of services and resources to early stage entrepreneurs. So the analogy of athlete to entrepreneur is a brilliant one in my mind. We see, you see LeBron James, you see, Tom Brady. They've got dozens and dozens of coaches for every aspect of their life. But when we ask an early stage entrepreneur to do the impossible, to go from 0 to 1, we give them very few resources to do it with. And so we're really proud of this aspect of our fund. I think it's the right thing to do, but I hope to the entrepreneurs listening as well, you can see this as a differentiation, right? This is really what we want to provide in terms of our value-add services. My hope, Rohit, is that at the end of the day, our portfolio is not just 10%, 15% of our portfolio being operational and profitable. I hope it's 30, 40, 50%. I hope we can change, literally, I hope we can change the business model of venture capital to create a success and an outcome scenario that is significantly more profitable and significantly more sustainable.
Interesting. You talk about Cadence. Is that like a software product? Is it?
It's not actually. It's no. Thank you for asking. Cadence Group. The URL is Find Cadence. FINDKADENCE. FindCadence.com. It's not a software because I think at times software it lacks the relational component of it. It is a service-based organization that provides world-class entrepreneurial coaching to early stage founders. And I think what's so different about it is, if you're a Fortune 500 or even a growth stage startup, you have the cash flow, you have the balance sheet to be able to afford something like this. But what about that founder who's at the very earliest stages of their business? They just took, maybe a bit of venture funding, maybe they're bootstrapping their business. How do they afford that coaching? Well, Cadence is doing a lot of amazing things to make it an affordable activity for entrepreneurs at the earliest stages. And I would contend that is the single most important point for a founder to have a coach. So much is being formed. I mean, it's like a child, right? You're absorbing all this information and you need to process, and you need to create something that reflects the values that you want for your business. So yeah, we partnered with them. We've been sending our portfolio founders have unfettered access to Cadence Group, which we're super proud of. We think it's an amazing relationship for them to be bringing on. And I'd encourage any other, both entrepreneurs or venture investors that have this same thought, the same thesis in their mind, to check out Cadence Group because we've been thrilled with them.
Yeah, no, absolutely. Super interesting. We'll put that in the show notes. And especially for founders, who are always looking to, who have so much on the plate. And, I think they need to focus on ensuring that they have the right talent and money in the bank account. What advice would you give to them on how do you focus on your day-to-day basis and on the mental and physical health?
Whew. Boy, that is a good question. It's not, you can't do it alone. Like, I don't know how else to say it. I mean, I laugh a little bit because everything you just said it's overwhelming. And you put it on a piece of paper to look at all the things you have to do in a day, and it's impossible. It's literally impossible. I had the chance to do a little podcast a couple months ago, and a similar question was asked of me, and the best answer I could give was, it's a set of priorities. At the end of the day, we are just a function of our priorities because you can't do everything. Some people can. They have limited their exposure to say, I can exercise and eat healthy and spend time here and do my job. entrepreneurs, I know for a fact that they cannot do everything, but you have to be very clear about what matters. I want to say that in two sort of contexts, Rohit. The first is, you have to decide what's more important, family, business, social life, friends. There is a season for each of those, right? I understand founders who don't want to spend time going to the movies or going to shows or whatever it might be because they're building their startup. That's not wrong, just to be clear, right? But it's a choice. And you have to understand that we're all just functions of the choices that we're making. So be intentional with the way you're prioritizing your personal versus your professional life. Let's start there. Then let's kind of drill back down into what's maybe a little bit more specific to this conversation, which is within your professional life, within your startup, the business you're running, how do you manage the important and the urgent? Something's always going to be on fire. There's just no doubt about it. Something's always going to be breaking. A customer could always use a little bit more attention, but that isn't necessarily the important thing that you're doing. The important thing that you're doing, and we actually, when we have conversations with portfolio founders, it's really simple. Tell me about your customers and tell me about your cash. That's a business, and I mean, we can get really complicated and we can get into all these different metrics, but how much money do you have before you run out of money and your business no longer exists? And what are you doing to bring in more customers? I can keep it that simple. And I think there's 1,000 things hovering around that and circulating that affect each of those different categories. But at the end of the day, ask yourself, is this thing going to help me preserve and or bring in more cash? And is this thing that I'm doing going to help me bring in more customers? And if you can do those things and be just absolutely religious about attacking those two buckets, I think you're going to give yourself the best probability of success. And so those are the conversations we have with our portfolio founders. One of the portfolio companies we have right now that I'm just so incredibly impressed with is a group that's building a platform. They're here in Chicago. It's called Ascent. Shout out to the Ascent team. They're building a platform for firefighters. It's an emergency response software platform that sort of consolidates all of the emergency response services that a fire chief might need to use. And I have been so impressed with this team because what they're doing, Rohit, is they are spending their days going to podunk towns in the middle of the state of Illinois and the broader Midwest, right? Places that don't have nice restaurants and aren't downtown Chicago, but they're going there and they're focusing on saying, hey, Fire Chief Marshall, Fire Chief Smith, what are the issues that you're struggling with? How can I make your job better? And more importantly, how can I make sure that at the end of this event that you're going through, we bring home every single firefighter in your unit? And they're sitting there and they're listening to the feedback and then they're building it into the product. And you know what they're doing? That is being customer obsessed. And so too often, I think we see folks building things in a vacuum and building it in their own echo chamber. And they're not going out into the market and saying, hey, tell me what's beautiful about this thing and tell me what's ugly. And I'm going to amplify the beautiful and I'm going to get rid of the ugly. And by the time I'm done, you're going to be a delighted customer.
Interesting. And you've been to B school. They teach you about market sizing, but
yeah.
Do you think with companies like Uber and Airbnb where investors could not look at analyzing the market size correctly, what are some of the biggest mistakes investors make when they analyze markets in the past, and how do you look at market size of a particular industry?
Yeah, boy, we could get into some technical analysis of the companies you bring up are really good examples. I think it's more of a theoretical conversation around what is the objective and purpose of a venture investor. I spent a little bit of time dabbling in business school and private equity, right? And in private equity, every single lever that you have, you need to understand if it's pulled, what's going to happen. If it goes this way, what's going to happen. I mean, there shouldn't be a deal in a private equity portfolio that goes sideways, right? Because you know all of the different variables. That isn't venture capital, right? I mean, we're not here to, people don't give us their money to do an excellent job of evaluating a market. They give us their money to understand where's the puck going, right? What's the next thing? And Uber and Airbnb are perfect examples. They created new industries, right? From thin air. And that's really quite something. So I think in general, what I see is, and my own sort of bias, if you will, is a lot of folks want to understand, well, what is that market? Tell me the exact number. I want to see a bottoms up analysis, not just top down, yada, yada, yada. We've all heard sort of those commentaries. But what I'm more interested in is how good is this founding team? How good is the product? And is it so good that the switching costs from an existing customer to what they're doing is something that I believe can happen, right? Because if we know that they can acquire new customers and they're creating, the phrase we like to use, Rohit, is a category defining technology, then it's not about what the market is today. I don't care what, statista study you find, a report that you're able to pull, because the market doesn't exist. They're creating a new category. And for that, we're really, really bullish. We invested in a company, another Chicago-based company. I'm not just saying Chicago-based companies, but there are a lot of really, really good ones. But your questions are prompting these comments. It's called Cyber Pop-Up. And the founder, Dr. Christine Issacourt, is creating, basically the idea is if you took cybersecurity for small and medium-sized businesses and you applied that to the gig economy, take Uber's business model and apply it to cybersecurity services. That's what her company, Cyber Pop-Up, is doing. And so when we were evaluating the opportunity, you look at the small and medium-sized business, total addressable market. First of all, it's ginormous. It's humongous, right? But I think we're just looking at a fraction of it because most of the small and medium-sized businesses don't properly handle their cybersecurity expertise in-house. And so if Dr. Christine can create a new industry, a new category defining technology that provides on-demand cybersecurity expertise to these small and medium-sized businesses, her TAM's already very big, but I think it's just a fraction of what it could be. So I don't think we're paid to understand exactly how to calculate TAM perfectly, Rohit. I think we're paid to understand where's the puck going, how are industries and users and customers going to evolve, and how do we find organizations that are capitalizing on those shifts in technology.
Interesting. And you're a smaller fund, but what are how do you look at conditions where you will have to collaborate with other VC funds? Do you think the venture capital landscape is getting more collaborative than before?
Yeah, it is. I love that. I hope so. Man. I love working with other funds. So you've had some great investors on this call, on this podcast, I should say, in the past. I'm honored to be here and to kind of follow in their footsteps. But man, I hope venture capital is getting more collaborative. I think the best investors understand that it takes a village. You asked me a few moments ago, how do these founders do it? And the answer is they need great cap tables. That's one of them, right? And they need they need investors that are going to do things to support that, right? I mean, we're trying to do our part, allocating to the mental health of our portfolio founders. Every fund's kind of got their thing, right, Rohit, that they can kind of hang their hat on. So personally, our approach to collaboration and syndication is we are for it. Now, that, of course, assumes that we have a trusting relationship with that other firm. I think the worst thing you can possibly do in venture is to lose somebody's trust by either being duplicitous or dishonest or whatever it might be. So we take a very open hand, sort of honest and candid relationship with other venture funds. And when we find deals that fit that venture fund's thesis or whatever it might be, we are excited, not just happy, we're excited to share it, because what that means is I know I'm bringing another great potential investor onto the cap table of my portfolio company. And that's a win. That's a win for everyone. So I think what I actually think is venture is we're sort of seeing the same thing that happened in the tech world, which is you're getting the mega firms, right? The I don't even need to name them, the mega firms. And then you're seeing a huge contingent of these niche emerging funds, right? Which I would include ourselves in, where we're sub $50 million, right? But we have a unique approach, whether it's, hey, I've got great deal flow and sourcing through Twitter and I really connect with my community, or I have a really unique value add, which I bring to the portfolio. I think this emerging fund community is incredibly collaborative. And I've been encouraged by that. I've had the chance to build and co-invest with a number of those folks, for which we're very, very grateful. And my sense is that that's where the industry is going, as opposed to companies continuing to get bigger and bigger and bigger. So I'm excited. We're thrilled and honored to be part of that group, and excited to see where it goes from here.
Interesting. And you mentioned a few times about Chicago-based startups, but also you've invested across US, but since the COVID scare has subsided, founders are going back into offices, or offices opening up. Do you feel that you'll go back to the days where you'll be restricted to a certain geography or a certain city, or do you think it's going to continue to invest across?
Ooh. Man, you're not holding back on me here. You're making me answer all the tough ones. I wish I had a crystal ball. I'll tell you my own experience. I think being in person, there's something about being in the same room as somebody that can't be duplicated over Zoom. That's just a fact. Right. And for that, I mean, our team is all located here in Chicago. As we're small, but we're expanding. So I do see sort of a distributed model in our future, but more towards the sort of founder and the startup question. I think each team has to make their own decision, Rohit. You know, I think some folks feel that the functionality they can achieve over Zoom, given the talent they can secure maintaining a distributed workforce, the ROI is there, right? It's a positive investment for them to make. But I think I've run into a number of other firms, Ascent in Chicago being one of them. They're all in the same office. It's an old fire station that they've repurposed into an office. And man, we go there from time to time just to check in on the team, and the productivity they're able to achieve in this beautiful office that they have is amazing. So I don't have an answer for you. I think the pendulum swung very, very hard in 2020 in one direction. Yeah. I think it's starting to come back, and we'll find somewhere in the middle where each team is going to make their own decision. I will say that's not a contributing factor to whether we make an investment. I'll just be very clear. I think there are some investors who are saying, hey, if you're not all together, we're not going to participate. That's not part of our investment thesis or our calculations.
Interesting. And I quickly want to do the top three. What's your favorite business book?
Oh, I've got a different answer. I don't know, maybe you haven't heard this one, but there's a book called Completing Capitalism. Is that name ring a bell to you, Rohit?
No, I haven't read that one. I'll look up to it.
Yeah, it's really good. There's so many. I don't know. I could have answered all this. I've been reading all the sort of trending books these days, but Completing Capitalism is a really interesting book, which looks at Milton Friedman's definition of capitalism from the 1970s. And Milton Friedman, at that time, the most scarce resource was financial capital, cash, right? And so his theory of capitalism was to suggest that we need to maximize for financial returns in shareholder value, right? We've all heard that. I went to the University of Chicago. I know it intimately. But the book takes a longer exposition about capitalism in general and says there's actually 4 forms of capital. There's financial, there's human, which is the talents that I bring to the table. There's social, which is now the relationship, Rohit, that you and I have. There's social capital to be had there. And then there's environmental. What are the resources of the earth that we are using? And the thesis of the book is that completing capitalism, the ideal structure of capitalism, is one that optimizes for all 4 forms of capital, as opposed to maximizing for just one. And I read it and it blew my mind. And I truly believe that there's a lot of challenges in our world, our economy that we're seeing today, which stem from the maximization of financial profits, as opposed to the optimization of all 4 all 4 forms of capital. So I'd encourage everyone to read it. You know, I believe capitalism works, but I think it works in a more opportunistic and a more optimized fashion, as opposed to what we see and a lot of the complaints we see in our economy, which is sort of the concentration of wealth. So I love it. It really changed my perspective on what capitalism is and what it can be. And it's something that we certainly try to achieve here at 11 Tribes.
Interesting. We'll put that in the show notes and I'll try to read this one. And
Great.
You know, if you could go back in time when you started 11 Tribes, what is the one thing you would have focused on or done anything differently?
Boy, it's not that I can't think of anything. It's like I can think of too many things that I would have focused on differently. No, I mean, our journey has been a really special one that I'm very, very grateful for. I think if there was one thing that I could do differently, it would have been to, it's kind of back to the question that we ask of founders when they go to speak to their customers. I believe that the best form of venture capital views founders as their customers. That's what we at 11 Tribes are trying to do. And I think the older model views investors, LPs, as customers. It's not to say that we don't as well. We're trying to service both of them. But if I could go back and restart 11 Tribes, I would have spent so much time, and we did some of this, but not enough. I would have spent so much time prior to the launch having conversations with founders, asking them, hey, what are the things that you need, right? Like, what's the pain point that you are experiencing as a founder? And what could an investor, what could a new fund like 11 Tribes do to solve for that pain point? So it's the exact same question that I'm encouraging our entrepreneurs, our founders, to ask their customers. And so it's been a journey of evolving and iterating on our model. But had we had more conversations early on with entrepreneurs, with early stage founders, asking them, what can we do better? How can we change the model? I think we could have been even more successful from the get-go. So we're continuing to do that today. We ask our portfolio founders and others all the time, what are things that we can be doing better? And I hope we don't get complacent. I hope we continue to iterate and find the best version of venture capital that we possibly can.
Yeah, no, absolutely love that answer. And what's your favorite online tools? Example, Gmail, Slack, Zoom.
Found this one recently. I struggle, man. If anyone has the same struggle, you're gonna love this. I struggle so much on calls, trying to pay attention and simultaneously take notes. It's just impossible, right? And anyway, it's called Fathom. And I don't even know these people. I should reach out because they're probably raising around, but I just discovered it on the internet. It's called Fathom, Fathom. It integrates with Zoom. It is a note taker.
Oh.
But it's so much more. Like, you can categorize each of them in real time. And so when you go back, you can pull out the specific text from that categorization. And I don't have to take notes anymore. I can just look at my Fathom recording and pull out the information that I need. So that is my tool du jour right now. And Fathom, if you're listening to this, reach out, because boy, I think I'm interested in investing in your company. So it's a great one.
Also, we'll put that in the show notes. Is it Fathom HQ? I was just trying to look it up on.
It's let's see, Fathom recording. Fathom, the URL is fathom.video. Right.
Oh, Fathom. Oh, interesting.
And it's free right now. I don't know when they're going to start charging for it, but it's free, which is super, super cool. So fathom.video. Highly recommend everyone check it out.
Yeah, we'll put that in show notes. I've heard about Otter, but I've not heard about Fathom.
Yeah, I tried both. I find Fathom to be a little bit more easy to use. And like I said, right now it's free. So might as well take advantage while you can.
Yeah, no, absolutely. We'll put that in the show notes. Mark, what is the best way people can reach out to you and know more about 11 Tribes?
Yeah, at the risk of getting bombarded, just email me. I love the best part of my job, Rohit, is talking to founders. So if you're a founder or even another investor, reach out. My email is just Mark, MARK, at 11tribes.vc. I'm on Twitter. I'm not that great at Twitter, Rohit. I'm going to be honest with you, but we do post. I do try to share some nuggets every once in a while. It's just Mark Phillips VC on Twitter, or just find me on LinkedIn. So those are really the three easiest ways. But man, if this is caught a nerve or struck a chord with you, I hope you'll reach out and let's have a conversation, because that'll make my day.
No, absolutely. We'll put down in the show notes. Mark, thank you so much for taking our time and speaking to us. I really enjoyed my conversation.
Thanks, Rohit. Great to be here.